Hey everyone, welcome to this week's weekly chat. Today we talk about how income preservation should be on top of your mind for your retirement and how you can use condos to do that. Watch now. Hey everyone, welcome to this week's weekly chat. And it's Alex Wilson, team lead of alexwilson.com, and we have Kyle DeVici with us, Director of Operations of Remax Wealth Builders Real Estate. And this week, I was reading the Globe and Mail, and I saw a great article that had nothing to do with real estate, but I thought really applied to real estate. So the title of the article in Globe and Mail, Income Preservation Should Be the Priority for Retirees. So in the very first line, the number one thing on top of mind for retiring Canadians is capital preservation is top of mind for most retiring Canadians. Going into the next paragraph, they said that's incorrect. That shouldn't be your top priority. Your top priority should be making sure you don't run out of money. So here's the line. Rather than ensuring they don't run out of money, investors and their advisors should worry more about creating a steady income throughout retirement that keeps pace with inflation. I thought that bells went off in my head when I heard that. So that was from Darren Coleman, Senior Vice President, Private Client Group and Portfolio Manager, Coleman Wealth Division of Raymond James Limited in Toronto. So why did that strike me? Does that strike anything to you, Kyle?
Yeah, it was definitely a change from the conventional wisdom out there.
And why it struck me, because I was like, okay, creating steady income, okay, that's a tenant living in the property paying rent, keeps pace with inflation. Okay, in a condo building, anything built after November 28 has no rent control, so I have the ability to increase my rent to market rates, so that would take care of inflation wise. So I'm like, wow, those are the two things right there that cover. I'm creating a steady flow of income with my investment property, and I'm protected against inflation wise because I have the ability to increase the rent on the property. There is no rent control on that. So it continues on. But providing income without significantly eroding capital is a conundrum for many advisors. And I'm like, well, it's not really a conundrum for me. Is it a conundrum for you?
Not at all.
Because when you own a property, and we've talked about this many times in all our videos, if I invested in a property today, both Kyle and I I turn 38 soon, he is 38. By buying a property today, we're gonna have tenants, and the tenant is gonna go there and they're gonna be, every month they're gonna pay off, I'm actually increasing my capital because they're paying off the mortgage every month. So paying off the mortgage every month. So my capital increases every month because I have a tenant in there. Part of monthly rent goes to paying off the mortgage and some of it goes to servicing the mortgage. But in 30 years, that mortgage will be all paid off. I'll own the property free and clear. I won't need to tap into the equity of the property, and then I'm getting the monthly rent that I'm going to live off of that does not have rent control on it. So I'm like, okay, well, I'm not eroding my capital and I'm still maintaining monthly rent. So then it goes on, Mr. Coleman says he typically uses a portfolio of blue chip dividend stocks, real estate investment trusts, and mortgage investment corporations for his clients. But here's the thing. I don't control the companies behind the dividend stocks, so I don't decide what the dividend's going to be. That's another person that's deciding that. I'm not the person making decisions behind the real estate investment trusts and what they're doing, and I'm not the person that controls the mortgage investment corporations for the clients. So I don't own those assets in regards to the physical assets that these companies are investing in. But if I owned real estate, I own the physical asset and I control my own destiny with that property. That's something that's powerful to me. Is it powerful to you, Kyle?
Yeah, absolutely.
Mm-hmm. And Kyle invests in stocks. I don't really have a large investment portfolio. He does. His is focused on what are they called?
EFTs? Yes, EFTs.
He's focused in on EFTs. He has some stock portfolio wise, but someone is ultimately making those decisions for you, right?
Yeah. Yeah, you're just investing in the general market essentially. It's not actively managed because you're buying the entire broader index. But that's where as well, I'm, on different asset allocation. Alex is more focused towards real estate, but it comes down to real estate does play a role in a diversified portfolio, and it can go a significant way to preserving your income in retirement.
Literally, you're investing it in a roof over someone's head, and they're going to exchange money to you for providing them a roof over their head. We've done our Maslow's hierarchy of needs. Shelter is one of the top things that people need, and if you get the shelter in the right location, it is always going to pay dividends. If you think all the way back, tangent time. If you think all the way back to the Dark Ages, the castles and lords and everything, it was as simple. There was rents on the land, and the rents were paid to the wealthy individuals, the lords, and the royalty that for exchange of allowing people to live on their land, they got the rent on it. This is an age-old, from the start of time, exchanging remuneration for land and a roof over someone's head, because that is a priority of individuals. But let's get back into the money-wise, because I'm going on my tangent.
Yeah, and speaking of the money, the fact that the rent does increase every single year is a factor that I think a lot of people forget about, and something that I didn't really appreciate when I started out investing in real estate. I was always worried about, is it cash flow positive from the very beginning? But that's taking too short-term of a view. We're looking out 30 years is, what our typical investment horizon. We're in it for the long term. We may not hold a specific asset for 30 years, but we are going to hold it for a long time. And we're going to hold some sort of real estate for that 30 years. And in that time, two things are going to happen. You already touched on it. One, the mortgage is going to get paid off. So I'm going to have that asset free and clear, continue to build my capital, and the rent is going to continue to go up every single month. Or every single year. But my fixed costs have already been fixed, ultimately, and those aren't going up anymore. Those are going down, while my rent, my income is actually going up and growing as well. So the longer out I wait, the more money I'm actually making on my real estate.
And that's where we continue on. That's important. So going in here, that's important because the cost of living is likely to rise even faster than the average rate of inflation over time, which we know. So, and when we continue on to the next line, for the average person, their cost of living probably goes up between 3 to 5% per year, he says, noting food, rent, and transportation typically outpace the Bank of Canada's target 2% inflation. What better way to hedge against your costs than having one of the things that's higher than your average rate of inflation as an income source coming into you? By you owning the asset that you're getting rent from, you can then offset the other items in your life where your cost of living is going up. And then flowing on, fixed income investments that yield about 2% obviously can't meet this need. We're not looking at a 2% fixed income investment. We're saying buy into real estate now and your return will be much greater than 2% on these properties.
Yeah, and you can't really buy a GIC or bond anymore because it pays so little. In Europe, they're actually negative interest rates that they're being charged. You have to pay the bank money to actually hold your money, which is ludicrous. Real estate provides an alternative to get a return that's beating inflation.
Oh, I love this next one. You basically need a pretty big stack of cash to invest to live off the income, says Mr. Diamond, whose practice focuses exclusively on ensuring near retirees and retirees have the proper retirement income planning in place, which I agree with. And his focus is near retirees and retirees. So what we're saying to you before you get to that point is that when you have that asset, again, you don't need that. You don't need to start with that pretty big stack of cash. You can have that down payment, that 20% down on that property-wise, and then the people living in your shelter, living in your condo, are going to create that pretty big stack of cash for you when you retire, so that then you're able to live off only the income of that asset. This also reminded me of another reason why I wanted to talk about this today. I've been having clients come to me that are actually in more of that near retiree or retiree stage, and they're saying, Alex, I want to buy a multiplex. They do have the big stack of cash, and they're interested in owning the asset and owning the real estate wise. The nice thing about owning a condo is that if I were to get you into that multiplex will be rent controlled. So then we lose that ability to to adjust our rents yearly to offset inflation pressures. I don't have the ability to increase rents on those multiplexes unless they were built after 2018, but the likelihood of that is very slim. And if they were, they're going to be extremely expensive. So we don't have the ability to raise the rent, so then we lose that inflation hedge on these. But if I go and just buy condos, which also, if I buy 6 condos or 4 condos versus a 6plex, let's say, I have the ability to adjust my rents every year to accommodate for any increases in cost due to inflation. But also, I have the ability to sell one of those assets if I do need a larger piece of capital in the future wise, and still have, let's say I buy 6 condos, I can sell one and then I have 5. There's a liquidity aspect to those condos versus the multiplex. If I needed to take a piece of capital wise, I would have to sell the multiplex or do a refinance, but let's say it wasn't an adequate time for you to do a refinance, I would have to sell the whole property, and then, as that old Portuguese man says, when you sell the chicken, you don't get any more eggs. So then we lose that fixed income, which is so important wise, but you do get liquidity by owning these separate titles on all these condo properties.
And you're building your own multiplex.
You're building, as we've said in other videos, you're building your own multiplex. We're building your own purpose-built rental building, but just having them in little different areas. So you're building your portfolio of real estate one piece at a time.
And you can customize, you can add a studio or a 2-bedroom, a larger unit. You have much more flexibility than buying one standalone large building.
Exactly, correct wise. And if something goes wrong with one unit, that's fine. You can deal with that one unit, as opposed to if something goes wrong with the building wise, that's your whole building and that can impact things. So there's a bit of not risk adverse. What word am I looking for? Diversifying your risk by having it in different properties and everything like that. So I thought this article was great and really applies to real estate investing, and then going to the next level, condo investing, because it's easy with the multiplexes. You'll get into a rent control situation, and the multiplex, it won't be downtown Toronto. So then, depending on the area your multiplex in, or the distance away from your house wise, it may require a more of an active management versus the really turnkey ability these condos offer, which is more of a passive style of investment. So income preservation, yes. Income preservation should be top of mind, even if you're not retiring today. This whole model works 10 years out, 20 years out, 30 years out. So start thinking about future you, invest in real estate today, and allow someone else to build up that big stack of cash for you so you can live off of that in your future years. That sound good, Kyle?
Absolutely.
Great. So if you guys want to use real estate to build up that big stack of cash so you can live off the income in the future, reach out to us. We want to build your financial freedom. We want to build generational wealth for you and your family and your children. So watch, and we'll talk soon. Okay, bye guys.